Hello and welcome, ladies and gentlemen, to a series of video lectures on option valuation. Because this is a slightly longer topic, I have decided to break it up into smaller parts so that we don't get overwhelmed by the length of it, and I also get a little bit of break as I speak. So let us begin this part of option valuation by acquainting ourselves with some basic options terminology. First of all, let's look at what an options contract is. What you're seeing on display is a very neat little definition for an options contract. It says that an options contract is a right to buy or sell some asset at a fixed price on or before a given date. So before we go into this sentence, please do remember that an options contract, like the forward and the futures contract, is a derivative contract because its value is derived from some underlying asset. So let me bring up a pen here and let's highlight a few things about this sentence and try and understand this a little bit clearly. An options contract, ladies and gentlemen, first of all, is a right. While this sentence is talking about the right, let's be clear up front about the fact that an options contract is a financial product. So when there is a product that can be traded in the market, there will have to be a buyer and there will have to be a seller. So now, if we consider an options contract as a financial product that can be bought and sold, when we decide to buy an options contract, we are essentially buying a right. So this is from the point of view of a buyer. So if you decide to buy an options contract, then you are buying for yourself a right. So this is from a buyer's perspective, this sentence. However, if you are deciding to sell an options contract, then you are not getting a right to do something. You are actually creating an obligation for yourself or creating a responsibility to do something, like honoring a promise. So once you acquire the stance of selling an options contract, then you are actually creating an obligation for yourself. So for a seller, or from a seller's perspective, the same options contract will be an obligation and not a right. Please do forgive my handwriting because I'm trying to write on the screen and the screen moves as I touch it. So the handwriting is a little bit wavy, but I don't think it should be a problem because I'm also speaking simultaneously and telling you that what I'm trying to write. So from a buyer's perspective then, an options contract is a right to do something. What are those some things? You can do two things if you buy an options contract for yourself. You can either buy or you can sell. So it's a right that you buy for yourself to do what? You can do two things. You can either buy or sell what? This is that thing. This is that what part. Some asset, which is an underlying asset. Maybe it's wheat, or maybe it's rice, or maybe it is a share of stock, or maybe it is a bond. So for example, if you purchase for yourself a right to buy a bond at a fixed price, and you can exercise your right on a certain date or before a given date, then actually you have purchased for yourself what we call a call option, C-A-L-L, call option. So let's go over this one more time. From a buyer's perspective, you go in the financial market and you pay some money, and by paying that money you acquire a right, and you can exercise that right to either buy something or sell something at a fixed price on or before a given date. One more time. You go to the financial market and you pay some money. When you pay that money, you get a right to either buy something or sell something. Ladies and gentlemen, let's stop here. If you acquire for yourself a right to buy something, then you have purchased a call option. And if it is that by paying the money you acquire a right To sell something, then you have bought for yourself a put option, P-U-T, put option. So options then can be of two types. If an options contract gives you a right to buy something, then it is a call option, C-A-L-L, call option. And if it gives you a right to sell something, then it is a put option, P-U-T, put option. Two type of options contracts. And we can exercise this right at a fixed price. Ladies and gentlemen, this fixed price has a name. This fixed price is known as the strike price. Strike price, also known as the exercise price. Exercise price. So this is the price, fixed price at which the option can be exercised, or your right can be exercised. Now this right can be exercised on a certain date only. That is, the options contract can tell you that you can buy something or sell something, whatever that something is, that will be mentioned in the contract. So you can buy or sell it, whatever stance you are taking, you can do that only on a certain date, that is on the date of expiry or on the date of maturity. Then such an option is called a European option, a European option. So please remember, European options, whether they are call options or put options, can be exercised only on the date of maturity. Then there are options contracts which give you a right to exercise the option any time before the maturity date or on the maturity date itself. So for example, if you buy for yourself a 3-month options contract and the contract tells you that you can exercise it any time during the 3-month period or at the expiry or the end of 3-month period, then such an options contract is known as an American option. American option, American. All right. Right, so let's go over this sentence once again. An options contract is a right to buy or sell. So if it is that you pay some money and you buy for yourself a right to buy, you have then bought a call option. And if it is by paying some money you buy for yourself a right to sell some asset, then you have bought for yourself a put option. And these options can be exercised at a fixed price, pre-specified price, known as a strike price or the exercise price. And depending on whether the options contract gives you a right to exercise the option only on the date of maturity or any time before the date of maturity, we can classify these options as either European or American options respectively. So let me bring up an eraser here and try to clear the space here, try to clear the scribbling which I did, so that you can see these definitions in a more neat way. And by the way, I have been continuously saying that when you go to the financial market and buy for yourself a right, the price that you're paying really is known as the premium that you're paying for the option. So that's known as an option premium or the option price. And somebody who decides to sell this right to you is known as an option seller or an option writer. Let's look at the definitions one more time. On the display, you're now seeing what's a call option. It is the right to buy an underlying asset. Remember, it is not an obligation from a buyer's point of view, but it is an obligation from a seller's point of view. Put option, right to sell an underlying asset. Again, not an obligation from a buyer's point of view, but an obligation from a seller's point of view. Strike price or the exercise price is the fixed price at which the option can be exercised. And then we have the expiration date, which is the last date on which the option can be exercised. And then the price that is paid to buy or acquire an options contract is known as an option premium. And someone who is selling that options contract to you is known as an option writer. sells the option and collects the premium from you for selling the option to you or giving the option to you, and therefore because that somebody is collecting a premium and getting money up front, they are then obligated to honor whatever promise they made to you. For example, if you decide to buy a call option, what have you bought? You have bought a right to buy. Right to buy what? Some underlying asset. It could be anything. Now, somebody who has sold this option to you will give you the right. They will tell you that, look, let's assume it's a 3-month call option. So so the options contract will say that during this period of 90 days or at the end of 90 days, depending on whether it's a European option or an American option. So during this time period, 90 days, you can come to me anytime. The seller is saying this. The seller of the options contract is telling the buyer of the options contract that, look, you give me, let's say, a couple of dollars now, which we are going to call the premium here, the premium which the option writer or the seller is going to collect from you. So the seller is telling the buyer of the options contract, look, give me a couple of dollars now, and in return, I will give you the right that let's just talk about a European option. So I will give you the right that at the end of 90 days, you can come to me and buy a share of stock. Let's assume that this underlying asset is a share of stock. So you can come to me at the end of 90 days and you can buy a share of stock from me at a fixed price, which we called as the exercise price or the strike price here. So let's give some numbers to it. Let's just have a little timeline here. Time 0 and day 0 and day 90. So the seller is saying to the buyer, give me $2 here, $2 here, $2 here. And at the end of 90 day, at the 90-day mark, you can come to me and I will sell to you one share of XYZ company at a price of, let us say, $40 per share. This $40 becomes the exercise price then. If it is so now the option seller has the responsibility that if you do, as a buyer of the options contract, if you do go to the seller's doorsteps and tell the seller that, look, I gave you $2 and in return you gave me a right that I could come to you at the end of 90 days and then I would have the right to buy a share of stock of XYZ company from you at a price of $40 per share. Now I have come to you, the 90-day period has ended, now I want my share of XYZ company and I'm willing, I can pay you the $40 for it. In that case, the seller of the options contract, because they collected $2 up front and created a responsibility for themselves, now they have an obligation. They cannot refuse you. They will have to deliver a share of XYZ stock to you and you will pay $40 to them. They cannot say that, no, look, the market price is now $45 per share, so why should I sell the share to you? Because if I sell the share to you at $40 per share, it will mean a loss of $5 for me. They cannot tell you that because they created a responsibility for themselves by charging you $2 up front. So the seller of the contract has a responsibility to honor the promise. On the other hand, if you are the buyer of the call option and you have a right to buy only, you don't have an obligation to buy. So at the end of the 90-day period, for example, you realize that the actual market price of the same XYZ stock is now $30 per share. So you can just leave your option unexercised. You can let it expire without bothering about it. So the only thing that you will lose is the $2 that you paid upfront to the seller. So even in that case, you will end up buying the share a little cheaper than the exercise price, because if you did exercise the option, what would have been the cost of your share? See, you paid $2 upfront, that becomes a cost, and then if you do exercise the option, you would pay $40. So the share would cost you actually $42. But you realize that the share price now at the 90-day mark is $30 in the market. So if you leave your option unexercised, because you have no obligation to exercise it, If you leave it unexercised, what's going to happen is that you have already paid the $2 to the option writer or the option seller. That is gone. But then you can pick up the share of stock of XYZ company from the market for $30, and the total cost of your share will still be 30 plus 2, $32 instead of $42. So you will end up in a better position. So please do remember as we proceed forward that once you decide to buy an options contract, you are buying a right. And if you are selling an options contract or writing an options contract, you are actually creating an obligation for yourself. And because you're creating an obligation for yourself as a seller, you get paid for it upfront in the form of option premium or option price. Right. This chapter, however, most of this chapter will deal with only the buyer's perspective. So we will be talking about only the right to buy or the right to sell. In other words, the call option or a put option from a buyer's perspective. Moving forward, we talked a little while ago that if an options contract gives you the right to exercise the contract anytime until or on the date of expiry, we are talking about an American option. And if it is that you can exercise your options contract only at the date of expiration, then it is a European option. And when I say you can exercise, I mean the buyer can exercise, because only the buyer has the right to exercise or not to exercise. Right. Now, let's say you have an options contract with you and you are evaluating at this point in time whether to exercise it or not to exercise it. Of course, the common sense tells us that if it is profitable for us to exercise the option right away, we will want to do so. So if that is the case, that if you realize that if I exercise this option immediately, I will be in a profitable position, then such an options contract is known as an in-the-money option. So an option which is profitable to be exercised immediately. On the other hand, if you find that it is not profitable to exercise the option immediately or right now, such an options contract is known as an out-of-money options contract. And if it is that you're indifferent between exercising or not exercising the options contract at this point in time, such an options contract is known as at-the-money options contract. No profit, no loss if exercised immediately. Right. So let's ask ourselves a few questions and try to understand the call and put options a little bit more clearly. I'm seeing a pop-up of some software which needs an update, so let's just ignore that and proceed to some questions and answers. So the first series of questions is about a call option, and the question says, when are you likely to buy a call option? Ladies and gentlemen, please do remember from a few moments ago that we said that a call option, when you buy a call option, you are essentially buying a right to buy. Buying a right to buy. In other words, in simpler words, you are locking in a buying price for some underlying asset. So whenever you buy a call option, you lock in a purchase price for a certain asset. So in the example that we took, we locked in an exercise price of $40 for the share of XYZ Company Limited, in the sense that no matter what happened to the market price, you always had the right to buy the share at a fixed price of $40. So you had locked in a price of $40. And when are you likely to do that? I'll give you two options and give you a moment to think about it. You are likely to buy a call option, number one, when you are expecting the stock prices in the market to rise. That's the first option. Or you are likely to buy a call option when you are expecting the market price of stocks to fall. So if you think about it, why would you like to lock in a purchase price is because you're expecting that the market price of whatever asset we are thinking about is likely to rise. And let's say this up front, that in this particular chapter, the underlying asset is going to be a share of stock. So which means that if you are interested in buying the shares of XYZ Company Limited, and you expect that the price of that share is going to rise in future, you can lock in the buying price by buying a call option. So therefore, you are likely to buy a call option when you anticipate the stock price to rise. The reason is simple, because if you have a call option, as you can see from the display, if you have a call option, which is the option to buy the stock at a fixed price, also known as the exercise price, and the market price of the stock goes up, you end up buying the stock cheaper than the market, and your gain is going to be equal to the stock price, which is denoted by this letter S here, and the exercise price, which is denoted by this letter E here. So if you are in a gaining position on an options contract, on a call options contract, your gain is always S minus E. Right. What if the market price of the stock falls below the exercise price? Like in the example that we took, where the exercise price was $40, and the actual market price at the end of 90 days ended up being $30. So if the market price falls below the exercise, what is going to happen in that case? So if you compute S minus E, what will happen? The stock price in the market is 30 and the exercise price is 40. So if you do exercise the option, you are going to lose. Let's not think about the option premium that you paid at the moment. Let's just think about these two numbers. So even by thinking of these two numbers, you realize that there is going to be a loss of $10. In such a case, what you are going to do? Remember, if you buy a call option, you have only purchased the right to do something. So if you feel that an options contract, if you exercise it, is not going to give you any profit at the moment, like in this case it's going to be loss making, then you can simply leave your option unexercised and nobody can do anything about it. So an options contract from a buyer's point of view is not an obligation, and if it's unprofitable, you can let it expire unexercised. So do you lose something in such a case? And how much do you lose? Remember, you paid, in the example that we took, you paid $2 to buy the options contract. That's the only amount of money that can be lost. So your losses are limited with an options contract. If you decide not to exercise the option because it's not profitable, then the maximum that you can lose is the premium or the price that you paid to buy that options contract. Let us bring in some numbers and compute a few simple things. Let's say you buy a call option for, let us say, $2. So now, how do you label this $2? This $2 here is the options premium. Option, so I'm just writing OPT, option, and then I'm writing premium, PR for premium. So this is the option premium. You pay $2 to buy a call option, and in return it grants you the right to buy the underlying stock for $30 per share. Now what this $30 means, this $30, ladies and gentlemen, is the exercise price, fixed exercise price, which I'm writing as E. So you buy a call option for $2 and it grants you the right to buy the underlying stock for $30 per share at the end of 3 months. At the end of 3 months, ladies and gentlemen, at the end of, not during the period of 3 months. So therefore, this is a European call option. So I'm just writing EUR to signify that I'm thinking about a European call option because it can be exercised only at the end of 3 months. Now the question, what is your gain if the market price of stock ends up being $35 per share after 3 months? So a gain on the call option can be computed, we saw before, as S minus E. So think of S minus E, if you want to think about it in simpler terms, think about it as the gross profit on your investment. So S minus E in this case is going to be what? The stock price at the end of 90 days is $35. So $35 is the exercise price, and the exercise price is $30 per share. So the gross profit, let's call it that for now, is $5. And if you want to think in terms of net profit, then please do remember that you will not be keeping all of this $5 in your pocket, because you paid $2 upfront to buy the options contract in the first place. So your net profit, so if I'm just writing here NP for net profit, you will have to subtract the premium. So I should have actually written the premium. So if I strike off this this N here and just say that this is nothing but the premium, PR. Premium is $2, which will need to be subtracted from it. So this $3 will be the net profit here in this case. If you don't understand the scribbling I have done, let me just get rid of that, and so that you can see this in a clearer fashion. So just give me a couple of moments till I clear out the screen, because I'm so used to writing while speaking, I tend to scribble. So you get to buy the stock for $5 less than the market price in this case, because the exercise price is 30 and the stock price in the market is 35. So the gain from the call option is S minus E, which is $5, but you also paid a $2 premium. Therefore, your net gain or net profit is $3 in this particular case. Now, if, however, on the other hand, the price ends up being $27 at the end of 3 months, do you lose? What do you think? Now, what is happening? This is the value of S in our formula. This is the S, stock price in the market. This is the S. So if you do the same thing again, S minus E, what you will realize is that S minus E will become 27 minus 30. That will give you minus 3. So you will be in a position that you, on a gross basis, you will lose $3, and on a net basis, you will lose actually $5, because $3 loss from the options contract plus $2 cost that you paid to buy the options contract, you will end up losing $5. So, but you do realize that you had bought an options contract, a call option, and which gave you a right only, and there was no obligation around it. So you say, since the stock is cheaper in the market, I am not going to exercise my option, and I'm just going to leave it unexercised. I'm going to just let it expire unexercised. The loss from the options contract will be, as you are seeing here, 27 minus 30 is giving us minus 3. But because you're not exercising, we say that the loss from the options contract will be $0 because you're not exercising it. So please remember, from a buyer's perspective, the payoff or the loss from the options contract itself is always 0 if it is unfavorable for you. It is never negative. Please do remember that. The payoff from an options contract, whether it is a call option or a put option, is never negative from a buyer's perspective. You never lose anything, because you simply don't exercise the option. And why you don't exercise it? Because you have the right to exercise or not to exercise. But on a net basis now, because you paid $2 premium to buy the call option, that $2 will be gone, and that is the maximum amount that can be lost in this case. A couple of moments ago, I mentioned the term payoff, option payoff. So let's just utilize that term. That is a more formal way of saying, of talking about profits and losses from options contract. So, in fact, let me just clarify it before we go to the next slide. Whenever you're thinking about thinking in terms of gross profit or gross loss in the context of an options contract, the term that you use is always payoff. So when I said the payoff from an options contract can never be negative, it meant that on a gross basis you will never lose on an options contract, because you will, if you are in a losing situation, you won't exercise the options contract. However, if you're thinking in terms of net basis, then the term used is profit or loss. Profit or loss, whatever the case may be. So on a gross basis, on a gross basis, the term that we uses always payoff. On a net basis, that is when we take into account the premium that we paid to acquire the options contract, we use the term profit or loss as the case may be. Right, so let's talk about an option contract's payoff from the perspective of a call buyer. Now you are getting exposed to another term. An option payoff from a call option, from the buyer's perspective, is the value of the call at the date of expiry, at expiration, and is known as its intrinsic value. Intrinsic value, IV, we are going to refer to it at other times also in this chapter. So please do remember at this time that the value of a call option at expiration is known as its intrinsic value. And what is the intrinsic value, ladies and gentlemen? It is a maximum of two numbers. Either it can be 0 or it can be the difference between S minus E. We saw that earlier. It cannot be negative. So either if it's a loss-making situation, the payoff or the value will be 0. If it's a profit-making situation, then this S minus E is going to be a positive number. So which means that in this case, the intrinsic value is going to be either 0 or S minus E, and as a rational investor, we will pick up the maximum of the two. So the intrinsic value of a call option is the maximum of either 0 or S minus E. If the stock price S is less than the exercise price, you know that S minus E is going to be negative in that case, then the payoff is 0. And then if S is greater than E, in that case, S minus E is going to be a positive number, then you will take that. Then the payoff is going to be S minus E and the option will be in the money. In this particular case, the option is out of the money, usually written simply as OTM, out of the money here, because it's not profitable. The payoff is 0. Here it is in the money, so we can write it as ITM, in the money. And if it happens, if it so happens that S turns out to be equal to E, that is the stock price is equal to the exercise price, then it is at the money, also written as ATM. At the bottom of the slide, you are seeing a little sentence there that assume that the exercise price is $30. So let's just draw a little diagram here to depict the payoffs that we are talking about. So let us say on the x-axis we are measuring the stock price, so I'm just writing S. And on the y-axis, we are measuring the value of the call. And when I say we are measuring the value of the call, I'm talking about the intrinsic value only. And why I say intrinsic value only is because the total value of an options contract, as you will see later, is going to be a sum total of two components. Let me give it to you here, and you will see it happening later also. The total value or the total price or the total premium for an options contract, may it be a call option or a put option. So I've just written here T for total, P for premium. You could have written T for total, V for value. That would mean the same thing. So the total value or the total premium is going to be a sum total of two things. The first component is going to be the intrinsic value that we are talking about on this slide. And then we are also going to add to it another component. It will be called the time premium or the time value. So the choice of letter P or V doesn't matter. If you write V, it will be value. If you write P, it will be price. So in any case, the total value or the total price will be comprised of two components. One of them is going to be intrinsic and the other is going to be time. So this T is not total. Why does this pop-up keep coming up? This T stands for time. Time premium. Time. And this T stands for total. Total. Right. So let's just do some markings on this graphing space here. Let's just do some class intervals. This is $10. Let's say this is $20. Let's say this is $30. Let's say, oh God, let's say this is $40 and this is $50. and so on. And on this side, let us write down some values for the call value. Let's say this is $5. Let's say this is $10. 10, difficult to write a zero. Let's say this is 15. Let us say this is 20, and so on. So, and let's mark the exercise price right away. Let's just mark the exercise price. Let me choose. Oh, come on, man. What's happening here? Let's just choose a different color. Let's choose black. So, well, this is the exercise price, $30. So think about it for a moment. If the stock price on the x-axis, we are measuring the stock price. If the stock price on the day of maturity is $10 right here, then what is going to be the value of this call option? Intrinsic value, that is, because on this slide we are only talking about the intrinsic value. So if the stock price at expiry ends up being $10, what is going to be S minus E? S minus E is going to be 10 minus 30, and in that case the result is negative. So because the payoff cannot from the options contract is not supposed to be negative, the value is going to be 0 right here. Now if the stock price ends up being 15 or 20 or 25 or 27, 28, 29, at all these prices, in other words, at all prices below 30, if you calculate S minus E, the payoff will always be negative, and therefore, because the payoff is not supposed to be negative, we are going to choose a 0 here. Remember, we wrote here 0. I'm circling here with black ink. I don't know whether you're seeing this or not. 0. So below $30, the payoff is always 0. This line here, 0 line. But once the stock price in the market crosses $30, let's say on the day of expiry the stock price is $40. Now if you compute S minus E, you will be doing S is 40 and E is 30, so 40 minus 30 is 10, which is a positive number. Now the options contract will have a value, intrinsic value will be $10, 40 minus 30, so 40 minus 30 is $10, so that is the value. So if the stock price ends up being 50, then the S minus E is going to be 50 minus the exercise price of 30. That's going to give you $20. So at $50 stock price, the intrinsic value is going to be $20 here, so somewhere here. So what you realize is that once you cross the exercise price, the line will start going like this. So this is the payoff line of a call options contract from a buyer's perspective. Ladies and gentlemen, please do remember that this is the payoff line. It will stay at 0 at all prices below 30 in this particular case, because we have assumed an exercise price of $30, and it will turn positive and go upwards here at all stock prices beyond $30 here. So if you want to make it a generic comment, you could just say that this is the exercise price E. So at all prices below E, it's a flat line at 0. At all prices above E, it's an upward sloping line like this here. This is the payoff line. Ladies and gentlemen, please be mindful of the fact that once we say that this is the payoff line, we are thinking in gross terms. In other words, we have not taken into account the option premium. In real world, what would have happened? So let me just erase this and draw another thing here to show you the profit and loss line. Just give me a moment to clear this off and get the pen back. So if this was the line, now let's do it roughly here. If this was the line and this was the exercise price here, and we know, let's just use black now, and we know that this is the payoff, which stays at 0 at all prices below 30, and not 30, let's just say exercise price. It's the payoff stays zero at all prices below exercise price and turns positive after that. Then if you were to draw a profit and loss line, let us just pick up another color here, picked up green. So if it is a profit and loss line, then you will have to take into account the option premium also. So let's just assume that you paid $2 premium to buy this options contract. So at all prices below exercise price, this region here, you are not going to exercise the options contract because the payoff is zero. So because you don't exercise it, you are anyway losing the premium that you paid for it. So you continue to keep losing your premium if this is $2 negative. You continue to lose your premium till the time you don't exercise your options contract, call options contract. That is, we are talking about a call option on this slide. And once the stock price in the market crosses this mark of exercise price, then the value of the option starts rising, and as it starts rising, you first of all recover your $2. So which means that this would be your break-even point. This is the break-even point, and because at this point you would have recovered your options premium that you paid to acquire the option. The stock price would have risen enough to allow you to recover the $2 that you paid up front, and then if the stock price rises more, then you are going to make a profit. So this green line is the profit or loss line. It's not very neat, but it's let me just make it darker. So it's supposed to be a straight line. Horrible attempt at trying to keep it straight. It has become really something else because the screen keeps moving as I exert pressure on it. So well, this line here, this one here is the payoff, and this one here is the profit and loss line. Okay. Continuing further, let's talk about when it is likely for you to sell a call option. So far we were talking about the call options from a buyer's perspective. So when you decide to sell a call option, or you become an options writer and you think to yourself, okay, well, let me try and sell a call option, you are assuming the responsibility of letting the option holder buying the underlying stock from you, and that's what you are seeing on the screen also on the display. You are assuming the responsibility. You're promising somebody that, look, at the end of the said period or during the said period, depending on whether we are talking about a European or an American option, at the end of the period or during the period, you can come to me and I will sell the stock, underlying stock, to you. So you have the option to buy it from me. So this would mean that you are taking the responsibility of selling the underlying stock at a fixed exercise price. So you have made that promise, and for taking up this responsibility, you charge an upfront price or premium. The question is, when are you likely to sell a call option? Again, you have two choices. You are likely to sell a call option when you think that the stock price in the market is going to rise, or that's number one. And the second choice is that you are likely to sell a call option when you believe excuse me, that the market price of the stock in the market is going to rise. So what is the scenario in which you will decide to sell a call option? When you are expecting the stock prices to fall or rise. Think about it for a moment, and you will realize that from a seller's perspective, it is advantageous to sell a call option when you're expecting the stock price to fall, because if the stock price falls, what's going to happen? The person who bought the options contract from you will not be motivated to exercise that option against you, because they will find it beneficial to buy the stock from the open market because the stock price has fallen. So what will end up happening? The options holder, in other words, the option buyer, or in other words, somebody who bought that options contract from you, will go to the open market and buy their stock. And what will happen to you? You will retain the premium that you paid for it. Just like the options holder or the options buyer was losing the premium, you will stand to gain that premium, and you won't have to deliver the stock also. So you are in a happy space. So you are going to win in this case because you sold the call option for a price, and the buyer of the call is not going to exercise the call against you, and you get to keep the premium that you charged. But if the stock price rises, then what's going to happen? Do you lose? So let's say if this exercise price was $30 and the stock price actually rose in the market to $50, and you had charged, while selling the options contract, you had charged $3 premium for the contract, then what is going to happen in such a scenario? Exercise price is 30, the actual stock price in the market is 50. So somebody who bought the contract from you is terribly motivated now to knock at your door and tell you, look, you gave me the right to buy shares from you. Here I am. Deliver the stock to me at the rate that you promised. What is the name of the promised rate, ladies and gentlemen? It's the strike price or the exercise price, which is $30 in our example now. So please deliver the share of stock to me for $30, and you may frown and you may fidget, but you will have to deliver the stock which is worth $50 in the market to the options holder now for $30. So your loss will be $20. Your payoff will be $20 negative in this case, because you're selling the stock for $20 less than what it is worth for. But on a net basis, what is your profit and loss? Remember, if you charged a premium of $3 up front, then your net loss will be $17 because you lost $20 on the options contract, but you had charged $3 as option premium up front. So we can take that $3 out from the loss of 20. So if the stock price rises, do you lose? The answer is yes, because you must sell the underlying stock for less than the market price. So let's bring in some numbers here. You sell a 3-month call option for $2 with an exercise price of $30. I think I don't need to label what item is what, but still here this is 3-month, this is the expiration date, and this is $2 premium, and this is the exercise price or the strike price. So this is what happens after 3 months. The market price ends up being $27. The question is, do you win? And the obvious answer is yes, you win, because in this case, the person to whom you sold the call option, the buyer of the options contract that is, will not want to exercise his or her option against you, because if they did so, it would mean they would be buying the stock for $30 and the stock is actually worth for $27. Why would they do so in their right mind? Something which is worth $27, why pay $30 for it? So they are not going to exercise the options contract against you, which will mean that the $2 premium that you charged from them upfront remains with you. So the gain from selling the call option is $2. And this is, ladies and gentlemen, from a seller's point of view, the maximum amount that can be gained per options contract. However, the situation is not so good looking if you turn the tables. If the market price ends up being $35, now the option holder, the person who bought the call option from you, is going to be motivated to exercise the option against you, because the exercise price you promised was $30. So they will definitely knock at your door and say, well, the stock price out there in the market is 35 and you promised to give it to us for $30, so now honor the promise. So they will exercise the call, and you will end up in a loss-making situation because you will need to deliver a share which is worth $35 for $30 only. And the loss from selling the call is going to be, remember how we used to compute the payoff from the call, S minus E, from the buyer's perspective. And I told you in a previous chapter that there's one good thing about derivative contracts is that they are symmetrical. So whatever happens to one party, the exact opposite happens to the other party. So if somebody wins $5, the other guy loses those $5. So from a buyer's perspective, if the payoff is S minus E, then from a seller's perspective, it is going to be the negative of that. So that is why you see here negative S minus E. So let's just carry out this simple computation, and you will see that S minus E would be 35 minus 30, $5, and you will put a negative sign in front of that, making it $5. So the loss from selling the call will be $5. So this is this is going to be the payoff, and the profit and loss would be, because remember you charged a $2 premium on it, so there will be a net loss of $3 in this case. In this chapter, I told you that we are going to focus only on the buyer's perspective from this point onwards. But please do realize, from a seller's perspective, the possibility of gain is limited to the amount of premium that was charged by the seller of the options contract, but the possibility of loss is unlimited, because the stock price in this case can go on rising. From 35 it can move to 40, to 45, 50, 60, and as it goes on rising, as a seller you are going to keep on losing, because you will still need to honor the promise and deliver the stock for $30, no matter what it is really worth for in the market. Even if it's worth for $100, you will still have to deliver it for 30. And so the possibility of loss in a selling position is unlimited. Alright, so let's focus our attention now on a put option. A put option, ladies and gentlemen. When are you likely to buy a put option? Well, a put option, please do recall, is a right to sell. So in other words, in simpler terminology, when you buy a put option, you are trying to actually lock in the selling price of the underlying stock. In more generic terms, you are trying to lock in the selling price of the underlying asset, but because in this chapter we have assumed that asset to be a share of stock, we are saying that when you buy a put option, you are actually paying the premium to buy that put option to lock in the selling price of a share of stock. Why would you do so? The obvious answer is that if you buy a share, if you have a share of stock, you may be apprehensive that the value or the price of that share of stock may fall in the market tomorrow. So maybe you have a stock, when you bought it, it was worth $60, and you are afraid that in 2 months or 3 months time the stock price may fall to $20, and you want to protect yourself against the loss in value of your investment. In that case, you might think, well, let me spend a couple of dollars, pay an options premium, and buy for myself a put option which will actually lock in my selling price, so that no matter what happens to the value of the stock at a later point in time, my selling price will remain fixed. So when you expect the market price of stock to fall, you will be inclined to buy a put option. And ladies and gentlemen, please do remember again that I told you that derivative instruments, and therefore options contracts also, are symmetrical instruments. So if you know what was true with the call option, the opposite will be true for a put option. So when we were computing the payoff for a call option, or the intrinsic value for call option, we said that we need to do a simple calculation that was S minus E. Now in the case of a put option, because it is a selling stance, which is the opposite of a call option, which was a buying stance, the formula will be reversed. We will say the gain will be, the payoff will be E minus S. This word should be actually payoff, not gain. So let's make that correction, payoff. You could write it as a gross gain if you want, payoff. So because if you expect the market price of the stock to fall, then you can gain in this case by selling the stock at a higher locked-in exercise price. So for example, if you have a put option with you which has an exercise price of $40 and the market price falls to $20, then you can exercise your put option. you can go to the option writer and say, look, I'm here to sell my share to you for $40. And the option writer will frown again because they will have to buy a share of stock from you now for $40, which is worth only $20. Remember, if you're selling your share, put option is a right to sell. If you're selling your share to the person who sold you the options contract, then the person who sold you the options contract is actually buying the share from you. So they are buying it at a much higher price as compared to the market price. So they will be in a loss-making position, and you will be gaining the difference between E minus S. Okay, so but what if the market price rises? Now I guess you know what's going to happen if the market price rises. Let's say if the stock price, if the exercise price was $40 and the stock price rose to 60, now you think to yourself, there is no use in exercising the put option and sell the share for $40 when it can be sold out there in the open market for $60. So you are just going to leave the option unexercised and it will expire that way. The only thing that you will lose is the premium that you paid to buy the put option, and that is the maximum thing that can be lost. But do imagine if you had only the share of stock with you and no put option. In that case, what would have happened? If the stock prices fell, you wouldn't have any protection at all, and your downside risk would be unlimited, because more the stock price would fall, the more you would lose, because you wouldn't have any locked-in selling price. So that is what the slide says here. The downside risk would be then unlimited. With every subsequent fall in this stock price, you will lose more and more. With a put option, of course, the maximum loss is limited to the amount of premium that you paid to buy the put option. And the gain possibility still remains unlimited, because if the stock price rises, you are not obligated to exercise the put option. You can simply sell your stock out there in the open market for whatever price it can get you. So like we talked about the option payoffs for a call option, let us look at the option payoffs for a put option from a buyer's perspective. So again, you have the same definition here. We are actually, whenever you say option payoff, we are talking about the intrinsic value of an options contract, and the intrinsic value is computed on the expiration date. So remember, for a call option, it was a maximum of two numbers, either 0 or S minus E. For a put option, it will be opposite. It will be a maximum of two numbers, again 0, but not S minus E this time. It will be E minus S. So if S is less than E, what will happen is that if you compute E minus S, the payoff is going to be positive, because E will be greater than S, and the option will be ITM, in the money, profitable to be exercised immediately. And if the S is greater than E, that is, the stock price is greater than E, the payoff from the option is 0, because, well, there is no sense in exercising this put option. Why? Because the stock price is already greater than the exercise price in the market. So therefore, you can sell it for a higher price in the market and leave the option unexercised, and the payoff will be 0. Remember, the payoff is never negative in the case of options contract. So again, we have an assumed exercise price of $30, and let us just do a quick graph again. So on this side is the stock price. I'm just writing P for it, and this side is the value of the put option. So this, I can't write two P's, so I'm just writing put here. I guess I need a gulp of water. The throat is drying up. So on the y-axis we have the value of the put option. On the x-axis we have the stock price in the market. So let's just mark here $30. This is the exercise price, $30. So what will happen in this case? If you find that the stock price is anywhere, let me just change the color, move to black. If the stock price is anywhere in this region, well, 35, 40, 45, 50, 55, 60, whatever. So if it is that you can sell your stock out there in the open market for $40 here, or $50 or $60, or whatever you can get, anything greater than 30, then you will prefer to not use your options contract. You will not prefer to exercise your put option. So in that case, what is going to be the value, intrinsic value of the options contract? This put option is going to have an intrinsic value of 0. So this flat line 0 here, because it is unexercisable. No point in exercising the put option because you can fetch a better price for your stock in the market. But if the stock price falls below 30, so let's say this is $25 here, then this options contract becomes valuable because something which is worth 25 can be sold for $30 now by exercising the put option. Therefore, it will have some value here. Likewise, if the price keeps on falling further, if it goes on falling further, the value will keep on rising. Value will keep on rising. So, well, I'm trying to draw a straight line, but I'm very poor at it. So let me just erase this one more time. But I think you have gotten the idea of what I am trying to say. What happened? Why is this not getting erased, this thing? Oh, very stubborn. Well, let me just do it all over. So let's just pick something else. Blue. So this is the exercise price, and let's now pick what should we pick with blue so that it stands out. Yellow. Yellow doesn't. Let's just pick red. So this is going to be the value of the options, put options contract, 0, as long as the stock price is greater than the exercise price. This is the exercise price, $30. So as long as the stock price is greater than $30 in this region, the put option will have a 0 intrinsic value. When the stock price comes to this region, the stock price, the put option will have a positive value. So this will be the kind of graph that you're looking at in the case of a put option, buyer of a put option. So ladies and gentlemen, the moral of the story therefore is so far that when you buy an options contract, the gain potential is unlimited, but the downside risk is limited to the amount of premium paid. So let me just see whether I've reached the end of the first session or not. Yeah, pretty much. So we are going to close off this session at this point, where we have learned about a few things. We have learned about the fact that there is an options contract is a right which you can acquire by paying the option premium, and that right can allow you to either sell a share of stock or buy a share of stock. If it allows you to sell a share of stock, you have gotten yourself a put option. If it allows you to buy a share of stock, you have gotten yourself a call option. And these options, depending on when they can be exercised, can be classified as European or American. The fixed price that you pay with an options contract for the share of stock is known as the exercise price or the strike price. An option, if you buy an options contract, you are also known as an options holder, and if you sell an options contract, you are known as an options writer. You are motivated to buy a call option when you expect the stock prices to rise in the market. You are motivated to buy a put option when you expect the stock prices to fall in the future. From a seller's perspective, the situation would be opposite. From a buyer's perspective, there is always the right and there is no obligation to perform. So therefore, the intrinsic value for either a call option or a put option is never negative. It is at worst 0, and at best for a call option the intrinsic value can be S minus E, and for a put option it can be E minus S, where the letter E stands for exercise price and S stands for the stock price. And the lesson that we have learned so far is that if you buy yourself an options contract, you cannot lose more than what you paid to get that option. So the maximum loss is limited to the amount of premium paid to acquire that options contract, whereas the gain potential remains unlimited. Ladies and gentlemen, that is pretty much I want to talk about in this particular session, and we will continue in part 2 in the next video. Thank you very much.